This is a pretty big moment in terms of big cycle of history and where we're going. The global trading system is unlikely to sustain in its current form, and clearly that has quite big implications. There's a lot of concerns starting to emerge. There's a window of vulnerability, whether it's linked to US housing, US credit, real incomes. The US has been consuming too much. The rest of the world has been consuming too little. Normally when that happens, currencies move and help adjust that imbalance. And essentially that hasn't been happening for the US for the last many decades, actually.
Today, I'm speaking to Tian Yang of Variant Perception. I've been a follower and a fan of Variant Perception for many years. What separates them from most other macro research products is the breadth and depth of their offerings. Whether you're looking for leading macro indicators, single stocks to express macro views, thematic opportunities, or short-term tactical trades, Variant Perception has it all. Because they aren't just one man and a Bloomberg terminal. Variant Perception is a team with the infrastructure and experience to provide true institutional quality macro research. I've been able to secure a special offering of Variant Perception for Monetary Matters listeners, so make sure to click the link in the description to learn more. Let's get into it. We've got an extremely important conversation today. I'm joined once again by Tian Yang, CEO and head of research at Variant Perception. Tian, great to see you again. How are you doing?
I'm doing good. Good to see you.
You too, Tian. I want to get your view about the dollar, stock market, and your typical tour of the macro landscape. But first, let's start off. You recently got a report out at Variant Perception about global imbalances. What global imbalances are you talking about? And also, why do they matter to an investor?
So this is a very big kind of thematic report, essentially trying to help ourselves and our clients tie together all the different kind of threads that's going on, right? There's a lot of geopolitics, a lot to do with the trade, the dollar. And so the short answer is the US has been consuming too much. The rest of the world has been consuming too little. And normally when that happens, currencies move and help adjust that imbalance. And essentially that hasn't been happening for the US for the last many decades, actually. And so we wanted to lay that out, explain why ultimately what we see is Liberation Day and the noise around tariffs, but a lot of the underlying pressures have been building for decades. And ultimately it's because the global economic system hasn't been doing what it's supposed to be doing. In theory, prices help adjust, trade deficits, react to the currency moving up and down. But ultimately, the reason none of these adjustments have happened and why we have such a big imbalance with the US over-consuming and the rest of the world not, is because the US has the global reserve currency. And ultimately, you have to supply it to the rest of the world if they want to. So we've generally seen the rest of the world have a lot of policies that prioritize jobs over profits and has prioritized essentially, keeping their currencies low to support exports. And in return, that means they've needed to demand dollars. And because US is the global reserve currency, they've just kept supplying the dollars to the rest of the world. And as a result, you end up with the dollar being artificially strong, which incentivizes the US to run a current account deficit and ultimately overconsume, which supports a lot of the export industries in the rest of the world. So, this isn't necessarily new. Obviously, with Trump's election win, even in 2016, right, everyone's talked about the role of China, manufacturing jobs in the US, going all the way back to 2001 when China joined the WTO. So it's just trying to tie all these threads together and say, look, this is a pretty big moment in terms of big cycle of history and where we're going. The global trading system, is unlikely to sustain in its current form. And clearly that has quite big implications.
So the US dollar is artificially overvalued because it's a reserve asset. We consume too much. We run a current account deficit and a fiscal deficit. And so the dollar should weaken in order to restore that imbalance, but it hasn't because the rest of the world wants to own those assets. That's been going on for a long time. In the 2000s, it was Asia accumulating a lot of U.S. debt securities. More recently, perhaps it was Europe accumulating a lot of U.S. stock securities, equity securities. Why can't this go on forever, Tian? What is going to cause the wheels to go in reverse? And the dollar has been trading quite weakly. You, in our interview, I believe on April 7th, aired on April 8th, the dollar index is down well over 4% in 2 months. That's quite a big move. Why do you think this is different? And what is your bear case of the dollar if all of these forces have been keeping it artificially high for so long?
I think the analogy is, it's a bit like the oil tanker keeps going, but then, you have enough people trying to steer the ship and start to turn. And it's pretty unequivocal in terms of the Trump administration, what they've been saying and doing, that there's a big desire to turn the ship, right? Going all the way back to when we last spoke, obviously Steve Moran's gained a lot of publicity with his papers before they joined the administration. And various members of the administration has talked about how the US cannot foot the bill or accept a lot of the cost for supporting kind of the well-being for the rest of the world, right? These become more of a balanced system, right? That's the language that's being used, and it's being followed through with policy action at the moment. So I think it's more this realization that, well, if the system had lots of policy distortions in it anyway, but previously the US just let the market decide. So the US wasn't responsible, right? It's like, as you say, Asian exporters decided, hey, I need to create a lot of jobs, support manufacturing in my own country. Therefore, I need to, buy a lot of dollars and sell a lot of my local currency to keep that competitiveness. That's fine if the US doesn't react. We're pretty clearly at the point where the US does need to react. And so when the US does that, clearly like the previous system will start to unwind a little bit, right? That's why, it's obviously more a political moment than the economic engine is adjusting by itself, because as we say, it hasn't been adjusting.
And talk to me what you talked about policy. Like you and a lot of people, I've noticed, that Trump has talked about a weaker dollar. Scott Bessent has talked about a weaker dollar. Never say we want a weaker dollar, but well, the dollar it's been weakening, but it hasn't really. The U.S. dollar isn't weakening. It's other currencies are strengthening against the dollar, and it seems like the solution to a lot of the problems that Scott Bessent and President Trump perceive is a weaker dollar. But what is the actual policy? There's tariffs, and then there's also currency policy. But just get into those mechanics as well, in a deeper way than just like, oh, Trump wants a weaker dollar. How's it going to happen?
Well, I think it's important to differentiate between the reserve currency status and the dollar's valuation exchange rate, right? Those are two separate issues. Ultimately, the reserve status is conferred by military technology superiority, right? And a lot of these factors. And ultimately, the US is still in a pretty strong position. As we're recording this, there's so many things only the US military can do, right? Who knows where China might catch up, but that's kind of a separate thing. On the valuation side, like I mentioned before, ultimately, can the US choose to consume less? Generally, that would essentially mean a recession, right? If that happens. And clearly the pain tolerance is not what anyone thought it would be going back to April. If you say, okay, the US doesn't really want to consume less, then the next question is, can the rest of the world consume more to address this imbalance? Well, they haven't been willing to do it. And if anything, if you look at China, they're not really doing a lot. Germany might be doing a bit of fiscal policy on the defense side. But again, there's no real sign there's going to be a big pickup in the rest of the world yet, at least. And ultimately, if you look at by magnitude, it's basically US and China, right? China's the big surplus, US the big deficit. So does China look like they want to incentivize consumption? It's not a structural thing. It's pretty marginal. Yeah, you do some consumption subsidies, pull forward some demand, go buy a new Huawei, iPad or whatever it is. But China is still very focused on kind of geopolitical goals, right? Leading in strategic important technologies, investment side. So again, there's no real sign that China wants to balance its economy. And if you look onshore, there's much more narrative about how China's consumption is mismeasured. China isn't actually under consuming, but the numbers don't lie at the end of the day that the US is the biggest deficit, China is the biggest surplus, right? One way or another, that's what's kind of flowing around. So again, there's a reluctance on the China side to do it. So if the US doesn't want to consume less, i.e., could result in recession, China also doesn't want to consume more because the Chinese elites that are in control have benefited from the current system. Then ultimately something else has to give. And then the answer here would be the dollar, right? But it's not a choice people want. It's ultimately, I think, the least bad of the options, I think, for everyone, for the US to ultimately try and force a devaluation. And there's historical analogs to this, where if this ends up being a unilateral thing, it will be analogous to when Nixon took the US off the gold standard, right? The so-called Nixon shock. Unilaterally, the US just goes, we're devaluing, dollar depeg from the gold, right? That was one. The other analogy is a more coordinated Plaza Accord style thing. And obviously, there's a lot of talk of Mar-a-Lago Accord, and etc. this time around. But again, that's about bringing your allies in, coordinating to say, okay, foreign central banks start selling dollars and do more, and again, foreign countries do more fiscal, help us balance, right? That would be the Plaza Louvre Accord equivalent. But again, if it's China and the US, they are not exactly best buddies, right? So that would be kind of tough. There's only three options at the end of the day, right? That's what the counting identity says. And even if you go back to Michael Pettis' work, Great Rebalancing, that's it. So the dollar is the least bad of the options, but it's going to be pretty disruptive. I suspect we'll have a lot of this kind of thing where you go through periodic big drops and then it just goes sideways for wild trends. There's a lot of positioning things. And then something gives and it has to have a big drop and then it just goes sideways for a period. That's probably where we're going to end up.
So there's three levers: are the U.S. saves more, the rest of the world consumes more, or the currency adjusts and there's a weaker U.S. dollar. That's a very helpful chart from that in the latter half of your report. We can put it on screen. Obviously, this report, for variant perception clients, as I referenced earlier, Monetary Matters listeners can get a discounted access to variant perception. We can click the link in the description. They can request that access and they can get a sample report. So people should definitely check that out. Tian, before we get to the investment implications, just how is this going to happen? Is there going to be a Louvre Accord, an accord where they actually intentionally kind of weaken the dollar, America and other people? Or, as something else hinted in your report, that there are going to be actually taxes on foreigners to discourage foreigners from owning U.S. assets?
It's going to, I think, quite hard to have a coordinated response as a first option. I think you will need things to go really badly first before the politicians are incentivized to sit down and work together, essentially, because essentially this is about US and China resolving this. So I'm assuming things have to get really bad before that happens. So there's a sequencing involved. So the first step probably is the US trying to unilaterally do something about it. So what would be the equivalent thing? It would be clearly priority is one, raise revenues, right? Because the US also simultaneously has obviously a potential fiscal concern. Again, I'm quite skeptical of this, the end of the US bond market, but clearly that is a dominant narrative. So the US needs to find revenues from somewhere. At the same time, incentivize foreigners to essentially not force the dollar to be so strong. But if you do want to hold US assets, but you keep it onshore, that's okay. If you invest here, that's okay. But if you're going to just pump up the dollar and then just, receive all the income and then just take it out, then that's not really aligned with, I think, the Trump administration's policy. So, it seems like the path of least resistance in a way. And obviously you've seen hints of that, with the taxes on foreign remittances. Some of the, right now it's kind of very conditional, but obviously this is kind of the trickle of things, right? You can think of essentially tariffs are just a tax on your trade, right? That's one form of flow. It's very reasonable to be like, well, capital also flows. Why don't we put a tax on it? And we'll raise some revenue. So yeah, I think these things are coming. Like, if you think back at all the things since the Trump administration took over, from JD Vance going to the Munich conference, when he was in Greenland, like every major person in the administration has given some messaging around the idea the US needs to be paid for delivering this public good to the rest of the world kind of messaging, right? That's like the overwhelming messaging. So yeah, that seems like a kind of potential first step.
So you see a weaker dollar. Tell us more about that and the investment implications. What time horizon do you see this weaker dollar on? I mean, as I said, we've weakened 4% in the dollar over the past 2 months. That's substantial, especially at a time when other risk assets have been choppy. And then also, which countries are going to appreciate more against the dollar, foreign currencies, and how does this impact your views on the global equity market and Europe and Asian markets versus the U.S. stock market?
So I think in terms of the relative currencies, the Asian currencies are kind of the most undervalued, right? So if you get any kind of normalization on any measure of RE or any of these things, like the Asian currencies have quite a lot of scope to.
All right, any measure of what?
Oh, real effective exchange rates, trade weighted exchange rates, and a lot of these kind of valuation metrics. In general, the Asian currencies are quite weak relative to the rest of the world and relative to the dollar. So there's a decent amount of potential for the Asian currencies to rally relative to the dollar. You've seen a little bit with the Taiwanese dollar already, as a disorderly way it's happened. But essentially, you'll have some kind of private sector repatriation flow. So essentially, these Asian countries have both their public and private sectors have bought up a lot of US assets. So they probably need to sell some to get back to less max overweight, right? They have to hedge it a little bit. And that hasn't really started. That's kind of potentially one path in which you'll get a more structural kind of reset in the flows out from the US. So I think the Asian currencies, in theory, should rally a lot. But obviously, that will put pressure on the export industry. So you realistically will need to see the Asian countries do more fiscal. So it's very interesting, for example, in Korea, where they have a dollarization problem, overexposed to dollar assets. They just obviously had the election, and then now the new president's talking about, hey, we need to do more fiscal. So these will be examples of things that could potentially allow Asian currencies to strengthen.
Mm-hmm.
But I think what's even more interesting is you can think of this as essentially the global trading patterns need to shift. And I think we even briefly mentioned this in April, but this is obviously bigger picture. But I think this is where the real investment opportunity is in terms of the multi-bagger, next few years kind of opportunities, where when you get these big generational political moments, sometimes they lead to a fundamental shift in what the global trading patterns look like by the end. And the analogy I gave at the time was kind of the Arab conquest of Europe, where essentially, if you back then, before the Arab conquest, all of European trade is centered on Rome, the Mediterranean, right? Because that's the legacy of Roman Empire. After the Arab conquest, the epicenter of trade initially moves east towards Baghdad, India. That's very intuitive. It's the Arab conquest. But what people miss was the power vacuum left behind in Northern Europe. And the Franks, and then that part ends up becoming a big trading hub and center of activity. And then that's kind of the less obvious investment opportunity that starts from nothing and improves. And there's many examples of this periodically in history. Another big one was when the Ottomans took Constantinople. So suddenly the Christian Europeans lost access to India, essentially, right? And that's what set off the age of exploration, Spain, Portugal, Vasco da Gama, people looking for a path to India, and ultimately who benefits? It's basically the places along the shipping lanes, the Cape, right? You got to sail around the Cape of Good Hope, so you got to go around Africa. Suddenly, these places were not really thought of before, but they start benefiting, and then that carries on until, say, the Suez Canal gets built. Suddenly, these places no longer on the main trading route, right? Because it's too far away. It's now quicker to ship through the Suez Canal. And then that was what allowed, Aden, which is like modern day Yemen, Malta, Gibraltar, these places that are now on the new trade route to benefit. And I think when you pull those threads together, you're like, okay, clearly this China-US one-way thing is starting to break. What's going to happen? And I think for us, like a very clear answer would be like Latin America as ultimately returning back to the US sphere of influence and being kind of a big beneficiary from kind of a changing of the global trading patterns, where the Americas becomes a block, and you also have various other historical analogies to the Monroe Doctrine and so forth. So I think that's a big winner. And the other one we actually really like is India as well as a beneficiary. Is just a country that can be relatively neutral. I would describe it as a bit like it's like the Yugoslavia of this Cold War, right? Where you can play all the sides up against each other, be friendly with everyone, and then ultimately be the neutral party that gets to have a lot of things funnel through you. So I think there's some of these really interesting things if you start tying together the threads that becomes like quite big structural winners. And then the last thing I think we mentioned in the report was, again, like US domestic reshoring themes linked to US AI, US domestic investment. That's going to be a big theme, right? That's going to be a lot of money behind it from the government to ensure the US builds stuff here and then invests here and keeps up. And linked to that is clearly still also real assets, right? Because obviously if the dollar's weaker and there's a lot of shifts in volatility in kind of all the fiat currencies, there's ultimately still a need for a move away at the margin towards kind of safer reserve assets, right? Again, I don't think this is suddenly the RMB is going to take over from the dollar, but at the margin, clearly people need to find some more neutral reserve assets, and gold seems the obvious answer still.
There's historical parallels are fascinating. So to be clear, you think India and Latin America will benefit because the U.S. will start trading more with them as the U.S. trades less with China?
Essentially, when the U.S., China, find a way to trade less, lots of everyone else in theory should benefit a bit more, right? I think that Latin America as a block just makes a lot of sense, and also the valuations are much cheaper. If you look at places like Brazil, the starting yields are super high, inflation's peaking, so you kind of have these big picture things aligning with the cycle, the more business cycle stuff as well, and very cheap valuations. So I think LATAM is many things going for it, where you could have a very classic kind of reflexive macro cycle in the way kind of George Soros talks about it, where interest rate starts coming down, inflation comes down, juices of asset class valuations, suddenly all the money flows in, there's all this FDI. It could be like this very mega cycle. And I think there's a lot of these dynamics kicking in. I think these places were kind of attractive anyway before this, because money needed to find somewhere to invest in that had true productive investment potential, right? If you look at most of the developed world, where this is due to demographics and so forth, trend growth is not that high. There's not that many places to throw money to get productive returns. But if you look at some of these, Brazil, India, these places at inflection point, there's a lot of like productive investment that can be made anyway, right? That's why these places ultimately have higher real growth. And if you have a lot of real growth, that covers you for a lot of sins. And on top of that, you have all these, it will be a beneficiary from the reorienting of global trade, from the reorienting of global geopolitics. And ultimately, if the dollar's going weaker, assets are going to go out from the US, got to go somewhere. There's not many places with the pull, right? It's kind of a push factor right now. People want to get out of the dollar, but it's not very obvious what's pulling you in terms of other places. And I think these are the places that, again, not huge markets, but I think that they have a lot of the pull factor as well, not just people avoiding the dollar, but people actually wanting to go there.
Hey everyone, hope you're enjoying the interview with Tian. What we're doing with variant perception is a little different than most of the other research offerings. As I said earlier, variant perception has an incredibly wide suite of tools. Normally, access to the entire variant perception platform of data, dashboards, research, and real-time alerts will cost a lot of money. But variant perception also offers read-only research at a more affordable, but still professionally priced cost. As listeners to Monetary Matters, you can get that research subscription at a substantial discount. And if you sign up for that research subscription, for 1 quarter, you'll have access to the entire variant perception platform. If you are a professional investor, you are never going to get this much time to test drive a product like you are here today. So go to the link in the description to get your free research sample and learn more about the tools you will have access to with this special offer. Back to the interview. So I understand that the flows, the Brazilian real strengthens a ton. It attracts a lot of capital. But on the fundamental just equity valuation and earnings, let's talk about earnings, because real GDP, country's growth can be extremely high, 10%, but its earnings can go nowhere in 10 years on the stock market. So, in this world where the dollar is going to be weakening a lot and foreign currency is going to be strengthening a lot, and that world you described, what happens to, like the corporate profits, let's say of Brazil or Mexico or India? India, I think actually the profits have been going up a ton alongside GDP, but in those kind of corporate profit laggards, let's say, what do you think that those profits go up a lot as well? And you describe that mechanics.
So obviously, I guess you're hinting at essentially China, right? China is the most prominent example of GDP not translating, but this is linked to the economic model. If you're mainly exporting, your domestic economy and your consumers and households benefited less than they should have, right? So if you have a lot of if your domestic equity market is ultimately exposed to domestic activity, they're probably the ones that haven't been able to keep up as much, because the whole policy has been focused on suppressing domestic demand relative to exports. But what's nice about Brazil, India, these places is previously they are economies that have actually, in a relative sense, probably prioritized domestic consumption a bit more, try to be more domestically driven economies. So in these kind of structures, generally, I think you'll have less of that kind of problem, where if your domestic economy and your domestic households and stuff truly benefit, you have a proper domestic business cycle. I think Brazil is very unique in that there tends to be actually a lot of high quality companies there. It tends to be quite oligopolistic. A lot of industries have, few players, behave relatively rationally, not too much competition. And it's also quite a financialized economy. So it's very easy for a local Brazilian to move that money into bonds and equities. So you have a lot of these mechanisms in place to really juice this kind of reflexive behavior. India is obviously a bit further behind on the financialization part, but India's like 7.5 real GDP, right? Ali is saying there's not many places you can go with that kind of potential, and it's real numbers because there's real investment potential there.
That's one of the things I really like about your framework and your work, Tian, is that so far we've only talked about macro. I think publicly, in many interviews in the past over the years, we've really only talked about macro. But I know you're a deep microeconomic thinker as well, and a lot of people in the macro business, they're incredibly brilliant macro thinkers, but they're saying, okay, the U.S. dollar is going to weaken. You want to own foreign assets, but it's like, what do you own? Like, do you own a Korean bank that the stock is the same share price as 20 years ago because it's a low quality company? Like, where do you actually put money to work? Because I guess what I'm addressing, Tian, is, okay, I understand that the US dollar has been overvalued and the US stocks aren't as good as people think they are, but there is a fundamental case. Like, Nvidia and Microsoft and all these companies have been growing their earnings and compounding their equity way better than other companies. It's not just about the macro. So, my question, Tian, is where do you put money to work? You already answered Okay, India, you like Latin America. But when talk about the rest of the world, and also can you bring in that little microeconomic lens, like what do you think about Chinese equities? What do you think about European equities? And I'll just share my own view. Not that I really value my own opinion, but just for the sake of argument, like everyone is getting so bullish on European stocks, and I see individual names that may appear interesting, like ASML, LVMH. Like those are companies that could be American companies and they're high quality. But it's like, do you want to own Air France, where the stock price is 5% of what it was 20 years ago? Or I'm maybe exaggerating slightly. And you've got some very serious hedge fund clients. I mean, they're probably not interested in Air France either. Like, what do you actually do?
Yeah, so we build a lot of kind of single stock kind of factor models, but it's not so much kind of the quant trading factor models. We have models for like the capital cycle, quality, and then a couple of crowding models, right? So in general, we're trying to look for very high quality companies that align to kind of the 3 to 5 year capital cycle for that industry that are not crowded today. And that's the way we're kind of trying to screen for names. And then once we have the names, we'll go dig into it, right? And that's kind of what's led to a lot of things from, when we did commodity super cycles, a lot of those things that came out. When we did age of scarcity in 22, investing in Mexican infrastructure, like that's how we're finding these names. Just like today in Brazil, and why do I think it's quality, right? It's showing up in the numbers. So I think the most important thing on a single stock basis is the capital cycle. So TLDR is ultimately you care about the profit pool the company participates in, right? What is the pool of profits that the company is essentially drinking from, and then and how many people are trying to like take that away from the company. And you can model it by tracking a lot of things, like overall how much investment has gone into the industry, what's that done to marginal returns, our company, is the industry and the profit pool in aggregate covering their cost of capital, is the ROIC in general covering the WACC, right? And things like that. So you can model these out by profit pools and then assign the profit pools to all the different stocks. And then from that, realize which companies are good or bad. And these are the models where it would have at least told you semis is still a decent place to be. It's not probably the best, but the score is still okay, right? Because clearly, to your point, they're way covering their cost of capital right now, right? The returns are very good. So even if people piling money in, it's not like, there's no real sign that the competition is kicking in. But you can kind of think of it as the best place to invest is ideally very low investment, capex, R&D spend for a while for that profit pool, yet the ROIC is going up and it's exceeding the cost of capital. That's kind of the ideal. The next one would be, hey, a lot of money's going in, but the ROIC is going up relative to the weighted average cost of capital. And that's a little bit more tech and semis kind of been. And obviously you start flipping the other side where, hey, there's been a lot of capex, but the returns are coming off. That would be really bad, right? So you can model these and use that to essentially tease out and score every stock in the world and aggregate it back up and use that as kind of a guide. So to your point, coming back to your question, yeah, Europe's challenging, right? Because there's not that many quality companies. When I travel around the US, people, ask, I give this analogy of, would you invest? When do you want to invest in California? There's a great weather. It's a great place to be. I love going there, but there's a reason companies have been moving out from there for a while, right? At one point, does the regulatory environment, the political environment, these things shift to make it a better jurisdiction to invest in relative to the rest of America, relative to places people have gone. And I think that's been the limiting factor in Europe for a while, that there's a lot of political regulatory constraints and maybe even cultural constraints that actually limit how productive these companies can be. And clearly that probably can explain a little bit the valuation discount over time. Sure, there might be some potential to catch up, but I think that's like a pretty limiting structural factor for maybe why the quality gap tends to be there. And obviously the demographics isn't great. It's not a particularly energy rich environment. If you don't want to burn coal, and you've backed yourself in the corner originally with the importing Russian gas, like there's a lot of challenges, right, structurally in Europe. So yeah, I'm probably not the biggest fan. And by the way, Europe is a pretty export dependent economy. The euro's nominal effective exchange rate, i.e. trade weighted exchange rate, is at all-time highs. So your exports are not actually competitive. You're trying to export because people think it's high quality. You mentioned ASML and things like that. But the other problem is the Chinese are pretty rapidly coming up the quality curve for a lot of products that the Germans make, right? The Europeans make. So that, again, if China's not going to be able to export to the US as easily, you're becoming more competitors to Europe than before. So it's just a lot of factors that, yeah, I'm not I'm somewhat skeptical that if you make me pick US and Europe on like, let's say 5 year, 3, 5 year, I would still say the US.
That's interesting. Because again, you're a dollar bear. A lot of dollar bears, they say, yeah, you gotta invest in Europe. Get out of your U.S. equities, put it into European equities. And you're saying not so fast. Okay, so that's Europe. Very interesting. What about China?
Yeah, China, I think the growth picture ultimately is still structurally challenged, right? Sure, maybe they'll do some stimulus. There might be a short-term business cycle, but fundamentally, the economic engine that you've seen since they joined the WTO doesn't actually function anymore, right? One, there's a big asset liability mismatching or most of the state-owned financial institutions. So there's like a pretty limiting thing in terms of credit growth, right? If yields start going up, you get asset liability mismatch. These things are insolvent. It doesn't work. So that's like a big problem structurally that you need to have some kind of reset, some kind of reform, bad bank, whatever to fix, right? They don't want to do that. The second thing was what was juicing growth was the local government engine, right? Essentially, it was the real estate market. You sold land, the land revenue was brought in, and the local governments could use it to spend it on things and stimulate the economy that way. That's obviously been broken for many years now. There's not as much demand for land, right? So local governments can't sell land as much. So you have to make up for the revenue shortfall, and they have to issue more bonds. So so those are two fundamental things that are broken in the kind of Chinese growth engine, and there's been no replacement for that. So I think it's still going to be pretty challenged. Valuation wise, it's still probably okay. Again, if you concentrate on the highest quality, some of the Chinese tech companies who are on the leading edge, who benefit from all the policies, then yeah, I think there's some good opportunities. But again, in aggregate, it's probably not that exciting. Again, the answer to allocate to China is probably not zero, because there's some high quality tech companies and things, some logistic company, and there's things that are okay. But again, if your growth engine is fundamentally broken, growth covers for a lot of sins, right? Going back to the India example, ultimately, if you give me a lot of real growth, there's probably there's a lot of corruption. There's various things you can look past and be like, yeah, there's enough for everyone, right? And I think China is still stuck with the problem of if your trend real growth is probably very, very low, if not zero, then it's going to be quite hard as a minority equity holder to invest in general there and expect to do really well.
You said real assets, you expect them to do well. Explain how that has to do with your thesis on the dollar and global imbalances. Because if the dollar is going to weaken against another currency, that's, one fiat strengthens or weakens against another fiat currency. How does that, why should that matter to gold, Bitcoin, oil, real estate?
Yeah, so I think this comes back a bit to this idea of the hierarchy of money. So, I'm a huge fan of Perry Merlin's.
Yeah, me too.
And I think we've discussed it variously, and he's been doing a few more podcasts, but I think it's so profound the way he thinks about it. Essentially, in good times, we think of lots of things as just like replacements for money, right? Like, hey, my dollar in my bank account is worth $1 in my mind, right? But when times are bad, my $1 at Silicon Valley Bank will suddenly not worth $1, right? Or like when times are good, hey, my Bitcoin is probably worth more than $1. It only goes up. When times are bad, oh, it's not worth $1. So essentially, the quality of money is about when things are bad, does it hold its kind of par value? So if you think about the hierarchy of money, I still think the dollar is pretty high up versus other fiat currencies if there's truly a problem, right? It's still probably like the tallest midget amongst all the fiats. But what is higher up on the hierarchy of money is obviously things more limited in supply. And obviously, Bitcoin has been getting a lot more traction, gold, real assets, productive assets, right? That tend to be more limited in supply. That people are thinking more about what are the things that ultimately hold par value. And so I think that's basically been the challenge, where the global trend is towards more fiscal deficits. We wrote the report, the structural limits of fiscal policy in 2024, right? Like at the beginning of 24, we basically pointed out, the history of the world is democracies need the majority support, and you just generally buy it by printing money. That's basically like the very short version of it. It tends to be debt just goes up over time. And so it tends to have this inflationary bias inside of it. And these forces are kind of really coming to a head and accelerating, right? And when you see that, suddenly people start worrying about the hierarchy of money. What is kind of the thing you should denominate your real wealth in, right? If you think a lot of these shocking stats, like, S&P in units of gold has not really gone up that much, right? But obviously S&P units of dollars obviously being like a mega bull market, right? And there's a lot of these things you can think about. to ultimately how much real value is being preserved. But essentially, this idea of hierarchy of money. So gold is higher up than a fiat dollar. Bitcoin is now higher up than a fiat dollar potentially, and so you're seeing a shift in this, and because of this trend towards global fiscal policy, maybe there might even be a global fiscal crisis if before the governments do this. People are more concerned of crowding to the higher quality forms of money.
And what is your view, Tian, on gold on the 3 time horizons, tactical, cyclical, and structural? And also, your quantitative work on it. A lot of people thought it traded on real interest rates, but actually, real interest rates that have been going up, which should be bad for gold. Gold has been going up as well, so that correlation is kind of broken. But does it not matter if every Asian central bank is just buying it tons and tons every day?
Yeah, so I think on gold, given so I think if this was the quote unquote normal world we were in, then clearly a lot of your trading models and things would be saying, yeah, gold's very overvalued. But if we are truly in the Nixon unilateral, attempt to address imbalance world, then you're in that regime, gold kept going up. Ultimately, it's going up because of the amount of fiat money in the world's surging at a much faster rate. So I think structurally, gold does have a place as an allocation in your portfolio. I mean, it's gone through quite a few of these short-term, LPPL bubble crashes, but they're more like short-term trading dynamics. But I think structurally, you need something there, right? Ultimately, yeah, it could be as simple as just literally is gold performing well relative to nominal bonds, right? That's the ultimate, I think, framework to think about it in, because obviously the nominal bonds is the government's piece of paper. Like, what value are you going to get back? And I think that's the one where the trend's generally still been towards gold because of this need to debase the currency. So I think gold structurally has a place. Yeah, obviously it's gone up a lot cyclically, so I wouldn't want to be maxed out. I want to leave some room to add on dips, but I still be whatever you would deem a core position. I would probably keep in gold. Yeah, that's where I would frame it.
That makes sense. Tian, earlier you said LPPL. What does LPPL stand for, and how do you use it, and how do clients use it?
So LPPL stands for Log Periodic Power Law, but it's just like a very fancy way of saying it's a bubble or crash detection kind of model. It was popularized in finance by Didier Sonnet, who wrote the book Why Stock Markets Crash. But essentially, the underlying idea is that a lot of the time markets are pretty efficient, right? There's more information than ever. Most participants act rationally, so you make buy-sell decisions based on your best understanding of the world at that time. So the market is mostly efficient, but there's lots of inbuilt mechanisms that cause markets periodically to become very inefficient, right? And that's linked to leverage, that links to institutional constraints, stop loss behavior. If maybe if a hedge fund is very levered, they start triggering a stop loss that knocks on to some other hedge fund. That there's a lot of these like short-term crowding, positioning, leverage dynamics, right? That sometimes cause buy and sells to happen. That's not due to economic rationale. It's just because of pure positioning. And so what you tend to observe in those things is that the market is not just going parabolic in a crash or bubble, but it has this very distinctive kind of wave pattern as it's going parabolic. And it just so happens that can be modeled by using this LPPL formula. So we just essentially use this to try and identify different assets around the world that's going through this kind of stop loss essentially behavior, whether to the up or downside, with the idea being that if we detect it, the idea is you want to fade it. You want to get in when the crash is just about done. So the advantage versus just looking at simple things like, hey, how much is it down? What's the RSI? What's the deviation from moving average? Those things are missing the idea of the wave pattern, right? You really want to capture this idea of the wave. There's a wave as it's going parabolic, and the wave is essentially what you actually observe when things truly kind of hit capitulation.
Yeah, Tian, I've got access to your research, and I find the LPPL very interesting, and it just goes to show the breadth of what you do. You do capital cycle analysis, LPPL, which is obviously more of a short-term thing. You do macro leading indicators. We haven't even talked about leading indicators. We'll get into that, as well as much more extensive, like kind of bird's eye macro, which we talked about, the global imbalances and capital flows and the like. As I referenced earlier, Tian, Monetary Matters listeners can get a discounted access to variant perception. Just tell people a little bit about what they get for a research platform starting on that base layer, not the institutional layer, but the base layer.
So, at this point, we've accumulated various models that try to understand the business cycle, the structural picture, and then short-term behavior, right? And then, so all those are built. Our job as analysts is sit over the top and contextualize it. What are the things the models can't capture? What's happening with politics? Some of our historical analogs and all these things. So, the ultimate output from that is the research we put out, and that's kind of the offering, right? At its core, it's a research offering. We'll cover the global economy, US, Europe, China, but also the rest of the MEM, flagging outliers, what's interesting, asset class overview, very similar to what we discussed, and then periodically the best ideas, right? We recently did a lot of things on US housing, a deep dive. Obviously, we talked about Brazil. We've done multiple reports on Brazil, which are the highest quality companies. So that's kind of the way I think about it, where the research is one representation of how we combine, interpret all our models, and that's kind of the core, research reader offering. For institutional clients, once people get a bit more familiar with our work, we try and build all our models to be auditable. So the more institutional clients will sometimes like some of the kind of one layer above it where, hey, this model is interesting. I want to know when my portfolio triggers on it, right? So this is my list of my portfolio is 50 stocks. I need to know when the LPPL goes off on this. And so you can set up your watch list, get alerting on your macro or single stock assets, and you get a daily email with summaries. And then once people get that for a bit, they might be like, oh, that's really interesting. How do I interact with more? And then we'll have a data API, we'll have interactive tools that then it can truly be a input into their process. So that's more the way I think about it. You essentially have research reports you can read, and then you have some kind of tools to just flag things for you, right? Whether it's alerting you when our model triggers by email, or we have certain chart collections, so you see all the charts we're scanning to come up with our research. And then the final kind of, I guess, VP aficionado tier is people who are like, okay, this is actually pretty good. Can I get the data directly? I want to play around with it either in the portal, or I'm going to pull it via data API and build into my own kind of models.
Thank you. And Tian, I think very highly of your work. There's two kind of tiers for me. Like, I think a guest is good enough for me to have them on Monetary Matters, but then a much more narrow tier is I think that they're good enough. The research is so good that I'm willing to partner with them and give access to my listeners and really connect you to. And there I'm only doing what I perceive to be the creme de la creme. And I think a lot of Monetary Matters listeners, some people are just interested and in finance, as an intellectual pursuit, but a lot of them are investors, and a lot of them are not just trying to invest, and they're trying to invest well. And I think your research platform really can help people do that. It helps me on my investment journey. And I also think that I just want to stress this a lot, that you do a lot of different things. So, people say, oh, macro, I don't really need to hear about the dollar or gold. Like, I just invest in single stocks. But you also do single stock analysis, and you have that micro single stock fundamental analysis baked in. So I think there are a lot of, it's not just macro traders who can benefit from this. And so that's why Tian, we can give a 30% discount to the research tier. And so if you click the link in the description, you can request access, and you'll get sample reports. And that 30% discount, it lasts for a month after this airs. So people should definitely check that out. And then also, I was able to secure for our listeners that institutional tier. On top of that, you also can get a 1 quarter trial of that for free if you subscribe to the research tier. So I feel good that I've got my audience getting them access, connecting them with the best. So people who are interested should click the link in the description. Tian, just to move on, let's talk about leading economic indicators. What are you seeing in the U.S. economy? We'll move on to other countries later, but and the impact from tariffs in regards to spending and inflation, growth, investment. When we did our interview 2 months ago, the news of tariffs was shocking markets at the time, but it didn't appear in the data yet because the data hadn't been collected yet. Now that we've got to over 2 months of data, what can you say? What does your analysis say? And we can put up some charts for our audience here today from your report.
The short answer is that you've had some pulling forward of future activity by most people in the economy trying to front run the tariffs, but you're starting to see that start to tail off. If you start looking at some of the latest import numbers from China, for example, right, those obviously surge and they kind of come off. So I think we're entering a window of vulnerability for growth over the next kind of few months in the US. Again, there's an obsession with calling a recession or not, but obviously these things are probabilistic, right? So, but the challenge with it is like, unless a recession hits, a lot of times you don't get that cascading falling asset prices. So, it's kind of this, you can't be half pregnant. It's either yes or no kind of thing. And so I think right now what you're seeing is that all the coincident data is completely fine, right? Because of various things like the tariff pulling forward activity. But on some of the models, you're starting to get some kind of cautionary warning signs. Hence this framing of, yeah, there's a window of vulnerability, whether it's linked to US housing, US credit, real incomes. There's a lot of concerns starting to emerge. But what I would say is, the main challenge today is, and what everyone's thinking about is, well, how is this similar or different to 2023, right? We have to kind of learn the lessons from that and contextualize what's going on. And, the lead indicator picture is probably comparable to 23 in terms of telling you, hey, a lot of the early warning signs are there. But compared to then, real income trends are kind of a lot weaker. The fiscal side, the impulse probably isn't going to be as positive, right? Doge might have come and gone, but it's unlikely the deficit expands from here. It just kind of maintains. Consumer savings rates are picking up. So it does feel like there's a lot more of a kind of a weaker foundation this time around. And so I think it's just time to be slightly more defensive position, right? I don't think this is quite, this is certainly not GFC or anything like that in terms of just how bad the LEIs look, but there's enough warning signs that we're entering window vulnerability. So what does that mean? I think it probably means yields need to come lower. The Fed's going to be a bit behind the curve. There's no need to worry that much about inflation when growth is going to become slightly more of the concern.
So growth, not inflation, is a concern. You're more concerned about a recession than an inflation. Talk to us, specifically about the LEIs. What is looking the most weak in the data, and how are you looking at it?
Yeah, so the way to think about it is that you'll have some, how do things happen, right? There's like essentially a fundamental cause and then the proximate catalyst or cause, right? So it's a bit like a child. If you build up a building with a bunch of blocks, but you build it in a really structurally weak way, and then it falls over. Well, why did it fall over? Is it because like the child banged the floor and it fell over? That's only the proximate cause, right? Fundamentally, it was an unstable structure to start with. And that's a little bit the way I would think about the economy. Like right now, we're picking up on the fact that the economy is fundamentally somewhat unstable, but it's very hard to know what that proximate catalyst might be. Maybe it's because the Fed doesn't cut early enough, and suddenly layoffs have to pick up because companies start laying off workers, and that starts affecting the housing market. Affordability is a problem. Home builders start being forced to give discounts to realize cash from their inventories. Right, it's very hard to know the exact mechanisms, but if you go generally and look at the structure of the economy, the labor market momentum was really, really slow. Right, after the latest revision, non-farm payrolls being below 150 for 4 months in a row. Again, very heavily revised series, but in general, even with revision, these things are quite rare and tends to warn of serious slowing momentum. We'll track some unrevised data series. The Treasury was holding tax data, right? And that's essentially like nominal income taxes collected for the whole US population. And that thing's basically gone to zero growth in nominal terms now for the last 2 months. You'll see challenger layoffs, right? Even if you strip out Doge, that's been pretty elevated, near about 100,000 layoffs for, again, 3-4 months. Now, even excluding Doge. So you have various things that historically have warned you of kind of a much lower margin of safety, a buffer for the economy if something bad were to hit. And so you're starting to pick up on that on the labor market. You'll pick up on that on the consumer. Real disposable income per capita is barely growing now. If you go back to 2023, this is growing like almost close to like way north of 5, right? I think it might have got to close to 10, right? That's a big difference in how comfortable the consumer is. As I mentioned, savings rates ticked up across whether you're wealthy consumers or not. Expectations really come off. Again, it's not a cliff edge. Trump took away the global depression cliff edge, right, by pivoting, but it's vulnerable. Housing, again, building permits, right? It's not going up. It's been pretty weak. And new home inventories are pretty high. Housing transactions are low. If yields don't come off, affordability is a problem. They can't shift the inventory. Nominal house prices are starting to tick down, right, month on month. So again, is it a cliff edge? No, but there's vulnerability there. And I think that's the challenge. When you look across all sectors of the economy, the uncertainty injected just means you're more vulnerable today. And so you're kind of in this, the way I would say is I wouldn't want to be max short equities, for example, but I'm certainly taking advantage of shifts in the vol surface to put on a lot of various tactical hedges. We're very focused on the shape of the VIX curve, VVIX. So when the pricing is reasonable, you start putting on left tail hedges, right? You can also put on some hedges around betting on the Fed cutting a lot more by year end, right? Those are pretty cheap ways to give you some convexity to this whilst you allow the data to kind of evolve. I would say right now, we've had the first month where the data trends are not good. If that carries on for another month or two, historically speaking, that's pretty bad. And the danger of a 2023 repeat, I think, is low today because in 23, kind of fiscal deficit, the impulse was very positive. There was a lot of excess savings. All those things helped to provide a buffer so that the income cycle and the credit cycle had this wedge stuck between it. Today, it feels like there's a lot less of a wedge, right? Like the wedge has to come from the fiscal side. Even though they passed the bill, the impulse isn't there. So in summary, I would say there's a window of vulnerability that makes it good risk reward to look for left tail hedges in basically front end yields and in kind of the vol in the vol space essentially.
Okay, so it sounds like you're seeing opportunities to hedge. You think the market is a little bit complacent.
Yeah.
And how much of this window of vulnerability is coming from tariffs? If tariffs were still at the low rate of 2 or 3% before President Trump came in office, what would you still be seeing this window of vulnerability? And also, you said Trump kind of took the depression scenario off the table because he moderated in rhetoric some tariffs, and technically he didn't lower tariffs. He just gave a 90-day extension, so tariffs are only at 10%. But on July 8th, for other countries not China, they're set to go up to those Liberation Day levels, and in August they're set to go back on China. So these only 90-day reprieves, and there's just so much uncertainty. Like, how do you try and model that? And also, in your economic models, just how bad do the numbers get once you get to those sort of high levels of tariffs?
Okay. Well, obviously, if the tariffs are going anywhere near the original numbers, then you don't need the model to tell you it's basically like trade embargo, right? Or just dysfunctional. I mean, you can think of it very simply as what are like typical operating margins, net profit margins for businesses. Not every company can be a software SaaS company with huge gross margins, right? Like if you just mechanically wedge the costs up, like that's clearly going to eat into margins. So yeah, I mean, I'm generally assuming like the base case is just 10% here to stay and things ongoing. So even in that scenario, it's still problematic because a lot of the real income and a lot of things I mentioned were starting to slow. But at the beginning of the year, what you had was some of these things were slowing down, but you had a nascent signs of nascent manufacturing recovery, right? There was some nascent signs of kind of a pickup in investment intentions and things like that, right? Linked to the kind of hope around deregulation, tax cuts. The problem is, I think Trump has injected so much uncertainty that all the future plans are still on hold, right? No rational business is going to go out and do a bunch of stuff right now, right? With this level of certainty. So you cut off that potential for investment and future kind of things. So everyone's just stuck doing the current bit. And that's problematic when things were kind of already slowing down and rates were high and real yields are high and so forth. So I think that's the problem.
So you're bullish on front end yields. The Fed could cut more than is priced in. What about the long end, the 10-year and the 30-year? Those have been trading quite poorly. What are your thoughts?
Yeah, so I think that's still probably getting to a point where it's going to become a great buy, right? So one of the things I look at is like flows and rebalancing ultimately matter. So one of the things you can track is to track the investment grade yield relative to kind of some of the pension fund assumptions for expected returns. Because we know ultimately at some point, because of the big kind of funding shortfall in pensions, at some point they'll need to step in and lock it in, right? And so you're kind of getting up towards those levels, right? When like IG yields start getting close to 6.5%, 7%, that's typically marked the top in yields because the kind of mechanical rebalancing flows kick in. And so so whenever 30-year gets towards 5, in general, I would think that's a reasonable opportunity for yields to peak. Again, it's going to take a little bit of time because right now everybody is aware that there will be some kind of tariff pass-through to prices as a one-off, right? That's not news to anyone. But if you look under the hood, where because of oil prices generally been slowing down, like a lot of the PPI indices have rolled over. If you look at the diffusion in terms of a lot of our LEI inputs, like broadly, I think less than half are even rising quarter on quarter now, right? So things actually calm down a bit under the hood. So if you take the inflation off the table, And if you assume like, the reason GDP now coincident data look amazing is because all the pulling forward of demand.
Mhm.
Now, then suddenly bonds start looking pretty reasonable. So if you're doing a multi-asset portfolio, suddenly you're like, okay, I should probably be relatively balanced instead of being too bearish or bullish on equities or bonds one way or another, right? This is like a reasonable time where they're both offering you a bit more. And I will be looking at more taking risk within the allocation. So within equities, large cap over small cap would be like a good expression of this, right? Within fixed income, yeah, front end a little bit, and then maybe if you're the back end, lean more into tips and inflation protected, right? That would be like some of the tilts you could do to reflect the macro environment. But yeah, I would say a window of vulnerability does not guarantee you, right? You're either pregnant or not pregnant. You can't be half pregnant, and we're stuck in that window right now. The probability is hovering around 50.
And I'm so curious your view on bonds because you got two things that are kind of pulling you in either directions. Number one, your cyclical view, you're not particularly bullish on the U.S. economy, and if there's a slowdown or recession, historically bonds perform well. At the same time, what we began our conversation with about your bearish view on the U.S. dollar, if the rest of the world sells or is just is less of a net buyer of U.S. assets, that can't be good for the long end of the U.S. bond market. So how are you? There's the macro view. It's only about bond yields only move on growth and inflation, and then there's it moves on supply. So if supply matters, who's going to be the marginal buyer of this quite large amount of fiscal debt that we produce every day?
Well, like I said, initially it'll be the rebalancing flows, and then it'll be the central banks or like quasi state actors. I just think politically it's basically not viable for, frankly, everyone in the world, for the US to lose control of the 30-year, the long end yield. So I'm almost like flipping the question, like that's something that will not be allowed to happen. So if you don't allow that to happen, where do you force the brunt of the adjustment, right? So if you don't allow that to happen, it's much easier to force it onto the dollar, right? So to your point, yeah, you could normalize it. You could allow either yields to go up a lot, in which case the dollar wouldn't need to fall as much to make the US a decent proposition to attract inflows again, right? So that's like a few ways you can think about it. Like, I guess it's that whack-a-mole thing. You push this part here, something else needs to pop up. So it just feels like most things are politically not viable. So like the dollar is going to be the one that bears the brunt. That's kind of acceptable to most people as an adjustment mechanism.
That makes sense to me. Yeah. So the pressure has to come out of the system somehow. If it can't come out of the bond market, the U.S. bond market, it's got to come out of the currency, the dollar. I like that. Tian, now I'm going to ask you if you could pull up just on your screen, you don't have to share it, but your report on the housing market that came out recently. We can go through this. Very interesting because you wrote this for clients, and the housing market was very strong in 2020 and 2021. When interest rates went up, so many people thought the housing market would weaken. Activity weakened in the existing home market, but that actually strengthened the new home market, home builders, and prices, did not decline, and actually they continued to inch higher. So tell us, what is your view on the housing market? And two, connect this to your view on the capital cycle. You talked about it earlier in some depth, but I'd love for you to explain it in a slightly a less complex way. And I'll just say by note of fact, I think when I first interviewed you in 2020, you talked about the capital cycle in energy and how there had been a huge underinvestment in energy and how you thought there would be a commodity super cycle. And that was, I mean, terrifically good time. We probably did an interview when oil was at $40, and obviously it's close to double that now, and then it was triple that for some period in 2022. So just talk about that capital cycle, about how there's no investment because there's like a crash in the industry, and then that ultimately leads to there not being enough supply and that being a very good return on capital, and then how that applies to housing.
Yeah, I guess the short answer is kind of the opposite way around now, right? So if you think about this is obviously specifically residential, U.S. residential. So home builders obviously are supplying the market, right? You build new homes. So ultimately, again, there's a difference between the existing stock of homes and the transactions. But in terms of the net in and out, it's basically household formation that you can proxy by looking at demographics, essentially. And you have home builders, are they building enough? And so typically you tend to build more homes than the growth in your household because there's, migration, replacement demand, and so forth. But in general, what matters is these demographic bulges. So essentially the two big bulges has been the boomers and then the millennials aging into like the prime age at which they essentially start families and drive up demand for housing, right? It's basically 30 to 40. Like I think the median first time buyer is now up at 38, which is pretty scary how fast it's gone up. But in general, that's the block. But you can widen it a little bit to 25 to 45, right, essentially. So that block, the growth in that cohort is extremely important for determining the net new demand, not just existing home demand. And that is really set to slow. Like millennials are aging out. So, I feel it. I'm a part of the millennial thing, that you start seeing it. Okay, so you're starting to age out of the prime family formation, right? But you've had this huge surge in building from COVID, right? There was an overestimation of demand in, hey, maybe everyone's going to move to the countryside, we're going to build here. And there's all these shift in demand. So right now, it kind of looks like structurally building permits are very high relative to the kind of projected growth in the kind of key kind of household formation, like first-time home buyer cohort. That is really flipping. And there's going to be a very big kind of oversupply structurally looking at it. So that obviously has pretty bad implications considering new home inventories are pretty elevated, right? They're sat on the home builder balance sheets. These things, a lot of home builders are still trading significantly above price to tangible book value. So I think that's a big concern. We originally started doing this because home builders were down 20-30% off the highs. We started doing the research. We saw, is this a buy? Right? That was what we started off doing because we knew the millennials were good. There were a lot of these tailwinds. And then after digging into it, suddenly we came out with the opposite conclusion. Now, actually, we're going to a pretty structurally challenged period while affordability is extremely challenged, right? Mortgage rates are very high. As we mentioned, real incomes haven't really been going up. Nominal income's gone up a little bit, but hasn't been able to keep up. So something's got to give, right? How do you resolve it? If either we have to hit a recession for yields to come lower, that doesn't help home builder demand, or home prices got to start coming off because the builders really need to shift inventory, right? The home builder's business model is the faster you turn your inventory, the better your cash flow conversion. You can then realize the cash and move on, build more homes, right? So when transactions are slowed down due to affordability problems, that's a real problem for the business model. And so that's why there's been so much discounting, but it's been kind of hidden discounting previously, right? Hey, I keep my price the same, but now you're seeing the nominal headline prices starting to come off, right? And in existing homes as well, if you look at the Redfin data, and that's the sign that you're like, okay, something's really starting to give. Yeah. I think that at some point, I do think there will be an investment opportunity in the home builders. You generally want to buy them when they're super distressed. A lot of the home builders have shifted their business models towards not carrying a lot of land inventory and only carrying home inventories. But the problem is those homes will depreciate, right? So that's bad. But I do think if you do have home builders with decent land banks in good locations, eventually they'll be able to monetize it, right? But they're the ones who have suffered in the current cycle because it's been very inefficient use of capital. But at least if you start trading below book value on land, in theory that's more monetizable in the future, right? You don't have to ultimately permanently write down the land most likely. So yeah, I don't think it's become a very, very interesting thing where the structural tailwinds shifted to headwind. The cyclical picture is just as bad, but you're starting to see it in the coincident data in the nominal prices, and that's become quite worrying.
And so you got this chart of building permits in black and in red, the change in the first time home buyer. And right now, building permits has gone up. So supply is going up. And you forecast that the change in the first time home buyer will go down. And even in 2045, it looks like actually that could go negative. That could be quite scary. Just talk to us about the demographics. Obviously you got the chart of the U.S. Annual number of births. Births peaked first in 1960 and then in the late 2000s. So millennials were born in the 80s and 90s. And has the boom in housing over the past 5-8 years been because of those millennials? And what happens? To the chart to the right, you've got this. I think it's one of the most fascinating charts about how the growth in the U.S. first-time homebuyer cohort, it exploded from 1970 to 1990. Actually, from 2000 to 2005, it went down. And that, to me, shows that the growth in real estate prices from 2000 to 2005 was really a speculative credit-driven thing rather than organic demand. But then from, I'm ballparking here, from 2009 to now, that first-time homebuyer cohort has gone up. So that shows you the boom in house prices has been justified by fundamentals so far. But you're saying that you forecast it to just to moderate, not to increase by as much, but not decline.
Yeah, in general, not decline. But the problem is, if you build a heck of a lot more homes than that growth rate, so that has to be digested. Plus, you've also had, obviously, the Biden year saw extremely high immigration, right? So if your immigration is good, like in the millions every year, that's like a pretty big boost, right? Building permits are like running at 1.4 million. We think realistically the steady state might be like 800, 900K. So that's a pretty big gap. So with the Trump administration policies, immigration probably isn't going to be as high. The millennials are aging, and you're coming off a period of pretty high building and pretty elevated inventories, and you're starting to complete on a lot of the things that were under construction. So I think it's the confluence of those factors together that it is that's what's challenging.
And Tian, so this is the secular theme. You're not particularly bullish on housing, maybe bearish on home builders, but it's not just the macros. We'll flash on screen for charts. You do an analysis of all these different companies, their price to tangible book value, and the land as a percentage of their total inventory, as well as the quality score versus their crowding score. So just talk about the analysis that you did there, and how do you measure home builder quality?
Given we're going to a downturn, I think the right, PE probably isn't the right multiple to price these things on, right? You want to know basically is it trading like the inventory is impaired? Because then it tells you the market's discounting the slowdown sufficiently. And, as we show here, there's not many home builders trading a significant price to book significantly below one, right? You would generally, if it's trading way below, then that's usually a sign, okay, enough bad news has been priced in. So that, like I say, only a couple of these tickers are right now. And again, in the good times, you don't want to hold land, right? In the good times, you sell your homes quickly. You don't want to tie up your capital. You can show amazing ROE. You look like amazingly high quality company. But like in the downturn, your home inventory, you might need to take a write down. And if that's the only inventory you have, that's a very big hit to your financial statement. So I think that's the reason why we teased out the price to tangible book and the land as a share of inventories to kind of find your long and short kind of outliers. And then obviously crowding, as I mentioned before, right? You care like how people position, how's the fast money position, how's real money position, what are the consensus analyst recommendations and estimates on this, right? To give you a sense of it. Yeah, if people are not positioned, then clearly there's kind of mean reversion potential. The quality score is kind of our own proprietary thing, but essentially has a few components where if you think about what does a quality business mean, it needs to have three things, right? It needs to be, one, very profitable. That's kind of what people normally associate. So that's anything from like, looking at ROE, NOV marks, consistency of it, cash flow conversion, free cash flow conversion, right? There's a bunch of these things. There's a second component, which is safety. Essentially, how solid is the balance sheet? What's the probability of defaulting? Does it have high quality assets on balance sheet? Is the accounting good? Is accrual versus cash accounting good, right? Like that's like a safety component, how high quality the financial statement is essentially. And the third piece we're actually sticking, which is more something we do, is like a growth component as well, but not in a classic what's revenue EPS, more in like how cyclical is the business, and in general, can the company, broadly speaking, maintain a sustained rate of growth, which again is pretty intuitive, right? Like if a business is growing but it's very, very choppy, that's clearly very different to something that's steadily accumulating. And obviously the most common examples like monopolies, right? Or like things like waste management, or these things like its necessary services will go up a little bit. So it has these three components of safety, profitability, and just consistency of growth. And so you can use that to tease out which of the business models are good or bad to at least segment the difference. And then what you want to do is go and dig to see why there's a difference. And so obviously on something like the home builders, and this is, by definition, the high quality names are the ones that got rid of their land bank, right? And the market loved them before because it was very innovative. You optioned the land, you basically added a lot of reflexivity to the upside for these stocks. And that's the reason the quality score is good. But if we're starting to see these things start to turn, then that might be a warning that these might not be as high quality as people think. So it's just about building these models to kind of make repeatable the parts that can be made repeatable to speed up our analysis. And then we can start our analysis by knowing what the model's captured and dig into like trying to understand why and does it make sense.
Mm-hmm. And I love that because that puts on display the microeconomic value of your research and how it can provide value to investors who invest only in single name stocks, and how you do thematics and macro, but also you have that fundamental view that I think is very important. Tian, I think I want to close by asking you about variant perception. How do you differentiate yourself in the research space, and talk about your quantitative process, how you're accountable, how you have auditable models so you can say, oh, I was right, I was wrong. I was 50% right or wrong, and how everything is clear and there are no guru calls. It's all very clear and accountable. Just talk about that.
Yeah, so I think the way we talk about it is like this idea of man plus machine, right? So not everything in the world is you can black box model it. I think there's a need for a human to try and think about causality, understand how the world works from like a big picture structural point of view, right the way through to the business cycle, right through to behavior. And then you figure out which parts are modelable and turn them into models. And then you sit over the top of it and try and interpret it. So I would say that's kind of in general the kind of investment process. But also I think finance as industry tends to be quite silo where, lots of people tend to be experts in their field, like really know it, but maybe not know other areas as much. And so I think the niche we try and live in is we don't need to be like the absolute max expert on any one thing, but we want to have a very wide lens and go deep enough across a lot of things to pull the threads together. And I think that's what often finds interesting opportunities that, day to day, maybe someone's not thinking about, right? Like, if you're just a G10 rates trader, you're very focused on that. You know everything about that, what the central bank is doing. But sometimes maybe the implication of a weaker dollar or interest rates could be, hey, there's also this thing here in Brazil and there's some very high quality companies and it's cheap and there's all these mega tailwinds aligning. And I think that's more the way we think about it. We're like deliberately generalist, but try and make sure we're accountable and go deep enough that I guess you know enough to be dangerous across quant, bottom up, and macro, but you essentially wait for these things to align to really make the big bets. And when they're not aligned, it's more like an excuse for you to not take too much risk. That's the way I think about it.
I really like that. And you've got specific time horizons, so it's clear, what the actual call is. A lot of people, they go on TV, they say, I'm bullish, a short-term bullish, but a long-term bearish. And ultimately, like anything that they say, whatever happens, they're going to be right. You don't do that at all, which I think is really important for being actionable and actually using something that adds value. Tian, just talk, who are, what type of different client types you have, both for institutional as well as, the research only. And are they all stock pickers? Are they all macro? What is kind of the split there? And where do they find the value in your research and process?
I think of it as like essentially three blocks, right? So one is you have the multi-asset asset allocators, right? So they're the ones who probably value the thematic stuff and and like the fact that a lot of our things are repeatable and that it can be like essentially a quantitative check or a human check for their process. For singles, we have a lot of single stock clients, but I would say they're way better at doing bottom up than us. But because we know enough to be dangerous, we can help contextualize the quant macro stuff for them and make a little bit of progress along the way to the true bottom up stuff, right? So it's not just, hey, we like Brazil. It's like, hey, these are the highest quality names we see in Brazil, and we think this is interesting, aligned to our thesis. And it speeds up their workflow that way. And obviously they can get alerted to when their portfolio moves. And the last one would be more traditional global macro, right, traders. So that's kind of more standard. You're very levered in positioning. You're looking at G10 or EM rates, FX primarily. But I would say in general, the unifying factor is that I think people like the fact that our process is more, I think, a lot more repeatable because it's more model driven, and then we can explain how we got there. So then over time, clients can know that it's more reliable. It's not just dependent on me, that the models can run. They can see it. They can pull the data. They can see the chart on the portal. And then when they read the research, they know that there's a bit more behind it versus, hey, this, today I pulled up this point and tomorrow I think this. Yeah, that's kind of probably the way I think about it. It's like multi-asset allocators, single stock, macro curious single stock. Mm-hmm. I would say investors, and then more traditional global macro.
That sounds like a lot of people in our audience. I mean, I'm definitely macro curious single stock. It describes a lot of me as well. So I really think some people in our audience can find a lot of value in your research and process. I really do. So people can click the link to request access for free. They can get just see what the research is like, see if they like it. And then, for a limited time, 1 month, they can get a discounted access. So a 30% discount. And then on top of that, they also get a free 1 quarter trial of the institutional product if they sign up to the research tier. So I really am glad that we were able to do this for our audience. And thank you everyone for listening. Tian, thanks so much. Talk soon.
Great to see you as always, Jack. Talk soon.
Hey everyone, hope you enjoyed that interview with Tian. Remember to click the link in the description to learn more about the special deal that I've secured for Monetary Matters listeners with Variant Perception. Throughout that entire conversation, the offerings and the capabilities of the Variant Perception platform were on full display, for short-term tactical trades to macro cyclical leading indicators and the like to longer term secular themes. But there was one thing that I want to mention that was kind of only lurking in the background. And, there were several calls recently that Variant Perception has totally nailed. I mean, most recently, I guess, is the bearish dollar view Tian expressed in our interview earlier in the spring this year. I also referenced the very secular theme of the commodity supercycle that I first heard from Tian and the Variant Perception team in 2020 and 2021. Now, obviously, those calls turned out great. But one thing that I think differentiates Variant Perception is the level of accountability and auditability of their calls. No one ever is right all the time, but I think Variant Perception is really good at making clear what they got right and what they got wrong. And if you're a serious investor, you understand just why that's so important. So remember to click the link in the description, learn more. Until next time.
Thank you. Just close this door.